Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everybody. Welcome to Tuesday at 10 o'clock. It's September 14th. Sorry to keep you waiting for a couple minutes there. It's 10:02. But I want to say happy Tuesday to everybody. And we've got we have a lot to talk about this morning, like we always do. And I'm going to give you some updates. So first of all, let me tell you that I will be on vacation beginning next Monday, the 20th, until October the 4th. So yes, that's 2 weeks vacation I'm taking. That's after taking hardly any vacation all last year and this year. I've had some weeks off, but they've been working weeks just away from the office, but doing things anyway, working the whole time. But I am going to be unavailable and on vacation those 2 weeks. So that means no webinar on the 21st of September, no webinar on the 28th of September. So we will be back here October 5th live at 10 a.m. And then October is going to be a big month. We start our next series of the Changing World of Retirement classes, and that is October 19th, October 20th, October 26th, October 27th, November 2nd, and November 3rd. So they're set up to be subsequent Tuesdays and Wednesdays, 3 classes each, 2 hours per class. So many of you who are on this webinar came to me through these classes, and you know that they're enjoyable. You're going to get invitations via email. The invitations are not ready yet. When they come out, I'm going to share them with you, and feel free to share them with your friends and family and loved ones. It's a webinar, so we can handle almost as many participants who want to be involved. So, and then starting on our October 5th weekly webinar series, we're going to get into year-end tax planning. And I'm going to be talking about specifics, what you should be planning for, what you should be looking for. And it's a big topic, so it's too big to cover in one webinar. So we're going to go over several. And we're going to go over what to be looking for and what to be preparing for today broadly. But yeah, it's that time. It's the middle of September. This is when we're already starting to talk about year-end tax planning. We're already starting to build out our Roth conversion spreadsheet. Actually, it's already been in practice really since the beginning of the year, but this is when we're really gearing up for our Roth conversions and year-end tax planning. We're going to talk a little bit about the Consumer Price Index. So the BLS, this is today. We're going to, the BLS released the Consumer Price Index reports for national and local areas. So we're going to talk a little bit about that. Inflation is on the top of everyone's mind lately. I hear people talking about it over and over and over again, and that's good. We should be paying attention to these things. So let me just check in with you all before I move on. If you can raise your hand, can everybody hear me okay? Excellent, thank you. All right, let's move you folks over to here. Okay. So let's talk about the CPI first. So the Consumer Price Index was released, the national average, US city average from August last year to August of this year came out at 5.3%. So that's higher than we've had in the past 12 months and lower than we've had in the past 12 months. If you remember, we had some 8 and 9s scattered in there. So that's year over year numbers. So one person, you could say nationally, inflation is up 5.3% for the year. Locally, here in Philadelphia, Camden, and Wilmington, this is the way the BLS, Bureau of Labor Statistics, breaks this down. Locally, the change is 4.6. Baltimore, Columbia, Towson is 4.5. I don't have any information for Washington, Arlington, and Alexandria. That's blank. The Northeast region is 4.4, and the Southern region is 5.6. So you bring that all together, that gives us a US city average of 5.3. I'm sorry, there's one other region here, the Newark, Jersey City area. So that's Newark, Jersey City area. And that came in below the average and below Philadelphia, Camden, Wilmington at 3.7. So 5.3 is still high. You know, the discussion is this going to continue, or is this, remember, this is adjusted over last year when we were just slowly starting to come out of the pandemic. Many people will say, is it fair to look at a CPI, Consumer Price Index, that is compared to the lowest that we've seen in a long time? There were negative, a lot of negative error. Think about fuel. Remember, fuel was $1.85 a gallon last year. You know, in the June, July area. So there's a lot of concerns about increased inflation. I think they're valid. Whether it'll pan out or not, of course, that's yet to be seen. But it's a good risk to plan against. So we can talk about how we plan and hedge for higher inflation. And typically that's with investments in equities or stocks. Or, you know, you can use stock funds, you can use ETFs, and choosing the right mix that's appropriate for you is really the art in that. You know, some people say it's science, some people say it's art. I think it's kind of a blend between the two, but there's a lot of things that go into it. So that's a consumer price index. So for this period, better than it has been over some other periods in the year, and worse than others. So we're kind of right in the middle there. 5.3 is, if we continue at 5.3, we're going to have a lot of troubles going forward. But don't forget that we've had a decade plus of really, really low inflation and really, really low interest rates. So the problem is that it's likely that inflation is going to continue like this for some time. The question is, are interest rates going to rise up? Why do we want interest rates to rise up? Well, if you're counting on your investments now going into retirement, higher interest rates obviously help you. Forget about investing in bonds and bond funds for a second, and the effect of the risk of interest rates rising and the value of the bonds. But I'm talking about savings accounts, CDs, short-term cash. So unless you're buying a lot of things on credit, you really want interest rates to go up. The question is, will interest rates follow inflation? I think eventually they will have a balance there, but obviously interest rates are going to lag for some time. Okay, so I'm starting a new thing that I'm going to try for you, and I'm going to ask you if you could. I'm asking for some feedback on these webinars. So we've added quite a few things. When we first started, we were just talking about the markets. This was March of last year, and the markets were falling off quickly, and I sat here. We started these at the time, they were twice a week webinars, Tuesdays and Thursdays, and we just started talking about the markets and what we should be doing, what we shouldn't be doing. And then I added on the financial planning topic. So we did a little bit on the markets, and we added on the financial planning topic. And I think the financial planning topic is really beneficial, especially for existing clients, which many of you are, because it reminds you of what we're doing on a regular basis and why we're doing these things. And you can have a successful investment strategy without financial planning, in my opinion. So they really work well together. We've added a couple of things along the way. I've added the slot updates and the slot reports, and many of you have found those interesting and helpful. I guess that's all we've added. So we have the slot updates, slot reports, the investment portion of it, where I talk about the returns of the investments, and then the analysts. I pick out some analyst reports typically, and then the financial planning. But I've also wanted to look at now, some headlines. So headlines often are just clickbait. But obviously we get a lot throughout the week. All of us do. And there's a couple that I pulled for you. And so I want to just have a brief discussion about headlines. But what I'd really like from you folks is, tell me what you like and what you don't like. Do you like the financial planning part? Do you like the investment part? Do you like it all? Do you not like any of it? I guess you wouldn't be here week after week if you didn't like any of it. But I'd love some feedback. Perhaps I'll put together some kind of survey at some point, but as we go forward, I just want to make these as enjoyable as possible for you. So let's talk about a couple of the headlines that I pulled out. So this came from Bloomberg. So the headline is Biden's death tax just took a big turn. So in this, they're talking about, there's been a lot of discussion about Biden's tax plans. So not a political statement at all. It's just, there is a move in Washington to increase taxes. We all know that. Washington insiders are saying that the elimination of the stepped-in basis, so that's one of the things that they're talking about. So that's when you pass, if you have non-IRA, non-retirement accounts that have grown quite a bit, when you pass away, you get what's called a step up or step two in basis. So basically, if you invested $100,000 and it's now worth $1 million and it's grown all that over your lifetime, if you sold it, everything, you would pay gains on that $900,000. If you wait until you pass away, currently, your heirs get a step up to the date of death to that basis. So now if they inherited that $1 million, theoretically, if they sold it right away, they would have no gains, therefore no tax. So one of Biden's plans is to eliminate that step up in basis or step two in basis. And that really affects people who have lots of properties, a family business, farms, or just regular investments. So they're saying, Washington insiders are saying the elimination of the step up in basis, often panned as a death tax by critics, seems to be heavily watered down or maybe dead altogether. The proposal received heavy opposition and Democrats may have already backed away from its inclusion in the budget plan or may go with the heavily diluted proposal. So they're saying that's potentially washed away. So that's just a headline. I'm not going to comment on that. We just don't know where that's going to come from. So I thought this was interesting. This reads, and that was from Bloomberg, and I think it was actually speaking on condition of anonymity, according to Bloomberg. So we don't know what the Washington Insider, who the Washington Insiders really are. They don't want to be identified. But this next one talks about Goldman Sachs. So the headline is Goldman Sachs makes a big call on stocks. So this is interesting. And I'm just going to read you two sections of it. Markets are fretting over a variety of concerns. Spreading Delta variant, we've all heard about that. Chinese regulator crackdown, you've probably heard about that. And Fed taper. So we talked about what tapering is just a few weeks ago. However, Goldman Sachs says these risks are overblown, as Delta variant will likely be less worrisome economically, and their Fed forecast is dovish. Goldman Sachs Fed forecast is dovish. So they go on to talk about areas where they see sharp turnarounds for higher equities, higher bond yields in the short run. But then it ends this paragraph, this big headline: Goldman Sachs makes a big call on stocks. They end this with this near-term cyclical rally won't last long, as they expect 2022 to deal from a different deck that won't be as friendly to investors. So this big call on stocks is about 3 months long. We don't invest that way, right? So we don't invest in 3-month windows, 1-year windows. We try to keep things, our investments and things that have risk longer term. So I just find this, that this headline caught my eye. Goldman Sachs. Okay. Goldman Sachs got some credibility, makes a big call on stocks. I want to see what that's all about. Well, the big call is about 3 months long. So we talked about CPI already. Let's jump into our slot updates. So we have two, and they are both by my friend Sarah Brenner. So remember, we had Andy Ives on a couple weeks ago. We talked about net unrealized appreciation. And I'm going to share that I had a situation with a client. We talked after our discussion about net unrealized appreciation. Ironically, we were doing a rollover, and there was some net unrealized appreciation opportunity for his 401k rollover. And when all the math is said and done, and this is why you have to do the math on these net unrealized appreciation opportunities, the benefit to him to taking a full distribution from the 401k, the paying tax on the NUA stock. And I know that's complicated, but you can go back and watch the NUA discussion with Andy to understand it a little bit more. So paying ordinary income tax on the basis of the NUA stock, and then paying potential capital gains on the on the growth of it, the difference to him was about $165. So we determined very quickly that $165 didn't make sense to go through the and push the distributions and go through the requirements of NUA. So, so that doesn't make sense. So the NUA doesn't always make sense. Some advisors get so excited. Well, NUA, I've read about these. I want to get this done. And sometimes it just doesn't have a benefit. So be careful. Work with somebody who's going to go through the process, who understands the process of the NUA. All right. So here is from Sarah Brenner, retirement account relief for disaster victims. Now, I tell you, I almost disregarded this for today, but I don't know what I was thinking, because here in our area, we have a lot of devastation still from the hurricane and tornadoes that came through just a couple of weeks ago. And in fact, when I was on the webinar with Andy, I got off and I sit here with my cell phone down so I don't get distracted. And I picked up my phone when we were all done, and I had a bunch of text messages, people saying, "Are you okay? Is everything okay? We heard there was a tornado in your area." And I had no idea. I was sitting here talking to you folks behind the computer screen, and I knew it was raining hard outside, but I had no idea about that. So my family and I went down to the basement until we figured out what was going on. But all around us, I have one of my friends I bike with. His house is intact. He lost a couple windows. The house next to him lost about half of the house, and then the rest of the block was completely annihilated. So it is really close, and really, I had a client who had to abandon his car and wade through water to get back home. Really scary situation, and they were pulling people out of cars the next day who had passed. So this has to do with account relief, retirement account relief for disaster victims. We have a lot of disaster around us and around the country, and it seems to be happening on a more regular basis. And we're going to talk about this at the end. President Biden, Sarah writes, has declared September to be National Preparedness Month. The goal is to encourage Americans to be more prepared for natural disasters. Unfortunately, from flooding on the East Coast to fires on the West Coast, the news headlines seem to be full of these devastating events, and an increasing number of Americans have been affected. You may not realize it, but you may be eligible for some relief from your retirement account when you're the victim of a natural disaster. Now, don't get excited. This doesn't mean you don't have to pay tax on any distributions. They just let you have access to these a little bit easier. Sometimes they give you relief on the required minimum distribution, like they did during the COVID relief, but nothing's going to avoid the tax. They just, a discussion here, just to sum it up for you, is to give people more access to IRAs and relieve that 10% excise tax, if you take it out under 59.5. But other than that, you're going to pay the regular tax. There is some discussion of eliminating that 10% altogether, but I don't think that would happen, just because these natural disasters happen more frequently. The IRS, though, Sarah writes in here, cannot, let me read what she says. While the IRS can grant some tax relief to the victims of natural disasters, its ability to do so is limited. There is some relief that the IRS does not have the power to give. For example, it cannot exempt early retirement account distributions from the 10% penalty. Such a change would require a change in the law, and that can only be made by Congress. So it's not about the IRS here, it's about Congress. But there is discussion about setting something in place there so that people can access those funds. This is one also from Sarah, this IRA rollovers and keeping track of your contributions. This is important. Many of you come to us and they say, and you'll say, okay, I have $1.5 million in my 401k, and $200,000 of that are after-tax contributions. So what does that mean? What's an after-tax contribution? That simply means that your employer allows for after-tax contributions. So you can make the typical payroll deferral amount, and if you want to contribute over that amount, then you can make that contribution after tax, which means you've already paid tax on that money. Therefore, you should not pay tax on it again. Now, you've got to keep track of that, and you should be filing a form with the IRS every year, and that form is the 8606, I believe. But you keep track of those, and you make sure that you're not going to pay tax on those again, because you're going to pay tax on the gains of those after tax contributions, but you should not pay well, you definitely should not pay tax again on those contributions, but it happens all the time because people lose track of them. And you've got to keep track of them. Typically the custodian will keep track of them, but then you've got to also not count on others and make sure that you've got that in place. All right. Let me find my place here. All right, there's another question here. Someone writes to Ed, I heard on a podcast that you're #1 authority on IRA, so I want to go to the most informative source, and that is true. Nobody knows more about IRA distributions and IRA situations than Ed Slott and his team. Could you answer this question for me? I have a Roth IRA and suddenly I was unable to view and edit my beneficiaries. I was told by the custodian that was because the account was moved from a previous bank when they were bought out. This happens all the time. I contacted the current custodian. They told me to open another Roth IRA with them and just transfer the funds. Do you see any issues with me doing this, such as the 5-year window or early withdrawals? So the answer is you can transfer. It's no problem. The 5 years is going to continue over as long as we have records of the initial contribution. You should do a direct transfer, Sarah writes, so that it's not considered a rollover. Especially within its own bank, they said you can open up a new account here and we'll get it all registered for you and get the beneficiaries listed properly. But here's the important part of this. The bank changed hands, was taken over by another bank. The person goes in, checks his beneficiaries, and they're not there. That happens all the time. When these institutions, bank, brokerage firms, whomever that are getting bought out, moving clients around, they're not paying attention to the minutia, unfortunately. And often the minutia is beneficiaries. So this is why you should be checking your beneficiaries every single year. It happens sometimes where they're listed incorrectly, they're listed how you don't want them to be, or they just completely drop off. So very, very important. But in this case, there is a remedy. The answer to his question is, yeah, go ahead and transfer it. Open up another account, transfers those funds in there, make sure it's set up correctly per their forms and their parameters, so you don't have any problems going forward. But the moral of that story is check your beneficiaries all the time. The next question is, I opened a Roth IRA in 2021 with a $7,000 contribution. Where will I report this when I file my taxes? Thank you in advance for answering this question. So Sarah writes, this is a question that comes up a lot, and the answer may surprise you. Roth IRA contributions are not reported on your federal income tax return. Roth IRA custodian, the Roth IRA custodian will send you and the IRS Form 5498 showing the Roth contribution. However, it's still a good idea to keep these records and track your Roth IRA contribution. This information is important to determine when your Roth IRA funds can be accessed tax and penalty free. So very, very important. The custodian is going to send you that Form 5498. Just keep your records. These records, I would say, most of them you can file, for after 7 years, you can get rid of them. But these records, I would say, just keep them. Scan them. Whomever you're working with, if you're working with us, we can scan them into your vault that you have. But just keep them, because it's really your responsibility, and it's very, very difficult to piece back this puzzle, and you don't want a situation where you're paying tax on dollars that you should not be. Okay, let's talk about investments. So in this past week, the markets were down. The week ending September 10th, the Dow Jones Industrial Average was down 2%, 2.11%. The NASDAQ was down 1.61. The S&P 500 was down 1.68. Still strong year-to-date numbers, 14.63, 19.89 for the S&P 500, 17.84 for the NASDAQ. One-year numbers are outrageously strong, 40% for the NASDAQ, 35.52 for the S&P 500. Dow Jones Industrial Average is 28.14. I said 40% for the NASDAQ. It's actually 39.45. I think that's pretty close to 40. The 10-year Treasury popped up a little bit from the week prior, was what, 1.32, and the close on 9/10 was 1.34. So coming up a little bit more. A year ago, the 10-year Treasury is 0.68%. My goodness, remember that. Okay, moving on. So Riverfront had some interesting things to say. They said, we continue to see the light at the end of the tunnel. We talked about, or they talked about, consumer spending will continue to trend higher in their view. So people are going to continue to spend. That should also drive up inflation. But they say, we believe inflation will settle into a range of approximately 2.3% year over year. We'll see how that pans out. And we believe the market will absorb policy changes under the Biden administration in an orderly fashion. So we'll see. You know, there's a lot of speculation, a lot of unknowns about what's happening in Washington. There always are. Hopefully we've got a pretty good weighting of Democrats and Republicans, depending on, what side you're on. You may like that or not like that. But in my opinion, the slower the regulation, probably the better for the markets anyway. It gives us a chance to really take a look at things and understand them and comment before things go crazy. Okay, let's jump into financial planning. Any questions before I move on? All right, so today we're going to tee up the next several bits of our planning section for our weekly webinars, and that is year-end tax planning. Just fixing something here. So the first item is income, of course. So we have, if you're still working, we have earned income, we have bonuses. So you want to get an idea of, and by now you should be able to plan, we're almost at the end of the third quarter here. So you should be able to plan for what the rest of the year is going to look like. And unless it's a brand new role for you or a brand new job, you have an idea of what your bonuses have been historically. So of course you're not going to be spot on, but start gathering that income, see where you are year to date. You can look at your pay stubs, or if you're self-employed, you can look at your QuickBooks or whatever you use and get an idea of where you are year to date. Any rents that you have coming in, not rents going out, of course, but rents that you have coming in, that's income also. Alimony, any pensions, Social Security. I have a lot of clients that are just crossing into Social Security, either deciding to, either just hitting their full retirement age, or they've hit the time when they've decided to wait until, or many more and more have hit age 70, and they're taking their Social Security for the first time. And in the first year that you receive it, you don't get the full amount. You get, unless your birthday is January 1, you get some portion of it. So it's a prorated amount that you get for the year, or percentage amount that you get for the year, not the full amount. But you want to determine what your Social Security is going to be for the year, this year, and then you should have a really good idea about that, and any other income that you might have. So get your income together. Don't forget about distributions from retirement accounts. This happens all the time. So people get their RMDs maybe back in January or February, and we try to do these not all at the end of the year, because it gets really taxing on us, and it also is difficult for clients. What if they're out of town? They need to sign documents, things like that. So we have developed over years now ago is that we issue the RMDs usually in the birth month, right? So if you're born in, if your birthday is in April, you get your RMD check in April or thereabouts. Sometimes there's not enough cash in the account. We're waiting for dividends, something like that. But that's what we try for, is the birth month. So clients receive their RMDs in the month they were born typically. And so think about that. If that happened in April, you may have forgotten about them. Well, check your RMDs. If you're clients of ours and you're not sure, send us an email. We'll send you your distributions for the year. That's easy. But don't forget about those distributions from retirement accounts. I've had people say, well, I don't know where this extra $100,000 in income came from. And I'll say, well, remember, we took $100,000 out of your IRA because you wanted to redo your kitchen. So what your past distributions are and what your planned distributions are for the rest of the year. We may have significant distributions planned for the end of the year. Let's just say you have a life insurance policy you're paying a premium on, and it's $40,000 a year, and it's scheduled to come out of your IRA. That might be a distribution that we know is coming, and we know that you're going to have to include in your income. Roth conversions, so past and planned. So sometimes we typically, well, that's not true. It's kind of half and half. Some clients will wait until the end of the year to do their Roth conversions, or towards the end of the year. Right about now is when we're starting it, as I said. because they're still working folks and we're gathering their income, or it's the first year that they're retired, or it's their first year they're on Social Security, and there's something that delays us. Many people, we do them earlier parts of the year, throughout the year, because we know what their income is likely going to be, and we can plan appropriately. So past Roth conversions in the year, the calendar year, and planned Roth conversions, that's going to be considered income too. So that's going to fall into the ordinary income, marginal tax bracket, graduated cylinder that we talk about. So it all piles in, and we've got it. What the goal is, we have to understand when we're talking about income, we have to, there's a measured amount that we want to plan for our tax rate, our marginal tax rate or tax bracket, whatever you want to call it. Remember, you can access that tax planning tool on attleborowealth.com. You go to the slot corner and there's a lot of graphs and charts that you can pull up in there. And I'll actually show you again real quick where you can find that. Let me pull it up quickly. That's the second time I referenced it. I should just have it up for you, but let me share my screen quickly. Trying to give you folks a lot of access to things. I've gone through. Here's our webinars I talked about over here. Just raise your hand for me if you can see my screen and you can see Attleboro Wealth Management. Thank you. So here's weekly webinars, special webinars, and live classes. That, I've got to put the next coming live classes in there. But go into the slot corner here, and if you page down, you'll see the first thing is 2021 tax planning. This is what I'm talking about. So we want to get a good idea where your income is going to fall. Some people don't want to go above this $329,850. Some people don't want to go above the $172,750 if they're married, filing, and jointly. Some people are okay touching into this 32% marginal tax bracket. So we want to get an idea of where you're going to fall. This is a document we work with all the time. In addition to the other tax planning tools we have, but you can have access to this. Just go in, you can hit this download now button, and that form is yours. Okay, let's stop that share. Capital gains. So we talked about Roth conversions. We talked about ordinary income, earned income, bonuses, rent, alimony, pension, Social Security, other income, distributions from retirement accounts, RMDs, past and planned distributions. We talked about Roth conversions. How about capital gains? What are capital gains? Well, we sell a piece of property. If you sell, I'm looking at investment properties right now, and there's a couple that had significant gains in the past a couple of years. Some people bought it, for X number of dollars, and they've made a couple $100,000 or $100,000 on that. If they sell that and it wasn't a place where they lived in, then they're going to pay capital gains on that. Now, if you invest, you've got a bunch of investments or any investments in your taxable bucket, and you sell them and you have gains, you're going to pay capital gains tax on that. Now, the capital gains do not fall, and this is a common misconception, they don't fall into that same graduated cylinder if they're long-term capital gains. That means you've owned it more than a year. They don't fall into that graduated cylinder and affect your what I just showed you, that the tax bracket, right, or that marginal tax rate, but you still have to pay tax on it. So it's going to affect your overall tax rate, the amount that you pay tax, I should say, pay in tax. So that is confusing. Some people will say, well, I can't do as much in Roth conversions because I got $100,000 in capital gains, and that's going to take me up over the $329,000. That's not how it works. But it does all come from the same pie, right? You've got to still pay tax on that money. So it is going to affect your total tax. So capital gains known and unknown. What the heck does that mean? Well, unknown is if you have mutual funds, we don't know what those capital gains are going to be until the end of the year. So starting in late October, November into December, the mutual fund companies start letting us know what their embedded gains are going to be. What their planned embedded gains are. So we know what some are, and we have unknown, and then of course we have planned. So we might use that same, you got a $40,000 life insurance premium that you're shifting over to life insurance, and if it's coming from your taxable account, well then that is a planned distribution, and we should know already where we're getting it from, what the basis is, and what that cost, what that gain will be, and be able to plan accordingly in a relatively relatively tight window. I see a question there. I'll get to it in a minute. Planned contributions. So you can contribute potentially to IRAs, 401ks, other retirement accounts, and Roth IRAs. So we want to have an idea of what that looks like, because we have Roth conversions. Some people are doing Roth conversions, Roth contributions, and Roth 401k contributions. You can do all three as long as you meet the thresholds. Okay, let's go to the question here. So that's what we're going to, let me just step back for a second. Sorry. So that's what we're going to talk about in more detail in the coming weeks. All those things: income, distributions, Roth conversions, capital gains, and planned contributions, to gear you up and get you ready for that year-end tax planning. All right, let's see what our questions look like. Let's pull you back down here. Gerard, Gerard writes, we are waiting for 2 more years to age 70 for our Social Security and will greatly increase our income. Followed by RMDs at age 72. How should we allocate our Roth investments funds would not be needed for income? Well, that all depends. So Gerard's asking me how we should allocate our Roth investment funds if they will not be needed for income. That's a good question. And what we see a lot, and Gerard, so Gerard he used to do what I do, and he's retired. So he knows I can't give him specific advice over this webinar, but he sets up a really, really good question. And often when we have clients come and we go through our financial planning process, and we go, especially the account segmentation process. So financial planning leads to account segmentation. It's all tied in together. Account segmentation feeds the financial planning. It's, again, all tied together. What we often see is an amount of money that's left to legacy longevity. What does legacy longevity mean? Legacy longevity means it's probable that you're not going to use this money during your lifetime. Of course, it's there for you if you want it or need it for something. If you want it, if you want to buy what you want to buy or go where you want to go, it's there for you. If you need it, extended care, whatever you fall into, it's there for you. But how should it be invested? Well, that typically, and I'm not saying this is how you should do it, but that typically is where the Roth IRAs live. And the can typically be the most aggressive investment in your strategy. Because if you're not going to need it, or you potentially may not need it, it certainly is 10 years, maybe 15 years or more out that you could touch it or may need to touch it. You have the ability to let that be more aggressive for you. Now, it's all different for everybody, Gerard, and you should not take that as a recommendation. But that is an exciting discussion to have. If you have kids, boy, it can be really exciting because you can invest very, very aggressively with them in mind. And of course, you need it. If you need it, you can pull it. And if it's tax-free, it can grow to be quite a lot that you're going to pass to your heirs tax-free. If you don't have children, and we talked last week about potential charitable contributions during your lifetime and at death, that we could have just identified an amount that's going to save you a lot of tax because you don't have to do Roth conversions. Maybe that sits there in your tax deferred account forever, and we can manage the required minimum distributions and we can manage the required minimum distributions potentially, and leave the rest of it to charity. So it can get very, very exciting on both ends of it, but you can't do it without the planning. You can't identify it without the planning. If without proper financial planning, you'll see this, all you're doing is guessing. You really need that planning process. So great question as always, Gerard. Thank you very much. And I saw your comment. Thank you. All right, seeing no other questions, I'm going to sign off for today. Remember, no webinar next Tuesday or the following Tuesday. We will see you all on October 4th. We have a lot coming up in October. Pay attention to your emails, your classes. There will be no special webinar in October because of all the classes we're doing. We'll pick that up again in November at the end of the month. And I'm planning on having Sarah Brenner with me to talk about naming beneficiaries, or excuse me, naming trusts as beneficiaries in IRAs. So that's a great topic. And Sarah, of course, is from the Ed Slott IRA group. Have a great week, everybody. Reach out to me if you need me. You can schedule time on my calendar if you need to, and I look forward to talking to you soon. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.